because I want to use this as reference, and anyone who is on the call, we can make sure that we send you the recording as well afterwards. I believe we have all of your emails, so we can send that to you after. So I'm Melissa Taylor. I just want to thank everyone for coming tonight, and Bella for organizing this, who is an agent on our team. And I also, Brennan, of course, want to thank you. You've always been supportive of not only me personally, but our team uses you as well, and clients. I've referred you so many clients because I think you're amazing. So I appreciate you for being here. And you are, I'm going to let you tell yourself about. Now, in the team, I just want to identify so people see who's on the team. We never know. So if you're on the team, if you can unmute and just say your position and your name, that would be great.
Hi, everyone. I'm Jack. I'm a realtor on the team.
Fantastic.
Hi, I'm Sandy. I'm Director of Operations.
Hi, I'm Debbie, and I am Office Administrator / stager / marketing person.
The do-it-all.
That's right.
Hi, everyone. My name is Bella. I'm a realtor with the team.
And you take it away, Bella.
Yeah, and yeah, thank you everyone for taking time and joining us this evening. And please stay with us till the end of the call, because your name will be entered to win a one-on-one consultation with Brennan. And also, I believe you all have received a free annual personal tax checklist upon registration. If not, please leave us a text on the comment section. We will email that to you.
Before you start, Brennan, I just want to let everyone know if they can just kind of stay on mute for the most part, just so we have no interruptions and we can hear Brennan. Type any questions, additional questions in the chat. And when Brennan finishes, and at the end, we'll get to those in Q&A. Brennan, you are welcome, though, at the end of each question to ask, does everyone understand that? Any other questions? Just so we can keep it compartmentalized. Good?
Sounds good.
Tell us who you are. There's Jane. Jane's on our team as well. Jane, agent.
Hi, Jane. Okay, so yes, my name is Brennan Ayres. I'm a partner here at SSL Group in Newmarket, Ontario. I've been doing this since I've been 18, so it's not that long, but it still feels like a long time ago in my eyes. But I'm happy to be here. Happy I've known Mel for probably most of that time period, like probably 8 years now. So yeah, we worked together on a lot of different things, and she's asked me to kind of help out, answer some tax questions that some of you have submitted, and so I will do my best to answer most of them. I have most of the answers. Some of them are, I might need some more context if the person's in here, because I didn't really understand quite what you were getting at, but I will do my best to decipher kind of where I think you were going and kind of give you an answer in that regard. So with that being said, I guess we could start with the first question that is on the list.
So the first question was, can a first-time home buyer get a tax refund?
So this was the question, actually. Oddly, the first one, I was like, oh, where is this person going with this potential question? It's twofold. Like there is a first-time home buyer's tax credit for anybody that has never owned a home before. The amount has gone up now because house prices have gone up, but the credit is $10,000, which actually just works out to about $1,500 in actual tax savings to you on your tax return. If you owe money, they just obviously reduce the tax. If you're actually in a refund, you just get a higher amount of refund by the $1,500. You can split it 750 if you're buying it with a spouse or a partner. So that's also available to you as well. In terms of like when they ask about a tax refund, yeah, I mean, sure, yes, it's always possible to get a tax refund in the year that you buy a house, but I think the question is probably more geared towards that credit, is my guess.
And so is that sorry, can I interrupt? Is that, I'm doing everything that I told them not to do, but is that over and above the land transfer tax credit, or is that what you're talking about?
Yeah, the land transfer tax credit happens on the time of sale. Like that goes on, that's all done through the lawyer's office. Just obviously tell them that it's your first time home buyer. and there's a pretty significant or not tax credit, but like land transfer tax reduction on your first house. But in this one will just be applied to the actual like filing of your tax return for whatever year you purchase it in. So they're two separate things.
Got it. So
Okay.
that was the 10,000. So if anyone is here, I'm watching the chat room religiously here. So if that was your question and you have additional ones, just type it in and we'll work forward from there.
Okay.
Next question. Anybody here have a question? You can put up your hand too electronically if you do have a question in relation to what he just was talking about. The next question is about tax implications. If we were to buy an assignment sale at cost, is there any? And so I guess they're meaning if put your electronic hand up if this is your question when I'm asking them, just because we can go to you for reference.
Mm-hmm.
So what are the tax implications if we were to buy an assignment sale at cost? So let's deal with that one first. Just purchasing can I clarify what an assignment sale is for everybody?
Yeah, that's a good idea. Yeah. Mm-hmm.
Yeah. Because some people may not know. An assignment sale is when you purchase something usually always pre-construction.
My questions I ask.
Sorry? Oh, I can't see you here. Did someone talk? Just put your electronic hand up if you can, just so I can see who you are. But I'm just going to...
That was Sachin that came in.
Oh, Sachin. Okay, Sachin, 1 sec. I'm just going to explain what an assignment sale is to everyone, but I'm glad you're on here because now Brennan can speak directly to you. So an assignment sale, when people purchase a property pre-construction, and then before they close that deal, sometimes it's usually quite a way out when it's going to close. Let's say it's 2 years. And then they decide, hey, the value of this property has gone up, even though it isn't built and isn't completed. And I'm going to sell it. I'm going to sell the contract basically to somebody else so they can close. So I don't have to close. I don't have to get a mortgage. I don't have to do any of that. I'm going to actually sell my contract to someone for them to carry forward. So it's a transfer of sorts. Mm-hmm. Okay. So that's what we're talking about is assignment sale. Mm-hmm.
Perfect. Yeah. So in that scenario where the tax implications about buying an assignment at cost, there would be no tax implications because it's just cost and you're just kind of transferring it. So if you bought it, couldn't close the deal and you just wanted to kind of get out of it. So let's say you paid 25 grand, that person gives you 25,000, no tax implications. Doesn't have to be reported anywhere. Just it is what it is. Okay, so we can go to the next one. So the next one about they had asked kind of like 3 different scenarios. One is if you sell it, if you kind of have a profit or if there's below cost. So the profit piece, this is kind of like a 2-part answer. Okay, so you can have a profit on some of these assignment sales because you could buy a pre-construction house now, and it might be built in 3 years from now. And as we all saw in the last couple of years, the housing rates just kept going up. So that property that you purchased pre-construction is going to be worth a lot more now than it was 3 years ago. So if you're trying to offload that assignment to somebody, well, you're probably going to end up charging them more and making a little bit of money on it. So the one question that comes to mind is everyone thinks, well, is this a capital gain? Can I consider this as my principal residence because I was maybe renting before and this was going to be my home or something like that? So the rule is that there's an intent behind the transaction. So in this, there's a couple of scenarios. So if the first scenario is, something comes up, you can't close a deal, maybe you can't get financing, you have to get out of it, then it's fine. It would just be probably considered a capital gain. If this is something that you're actively doing, maybe more than one time or multiple times in the, several year periods, CRA may consider that like, okay, this is actually a business for you. And then any profit, there is no capital gains treatment. It's all 100% goes as business income and you pay tax accordingly on that. So there's no like definitive right answer. It's just, if they ever looked into it, if you were doing these assignment sales, like kind of like buying and flipping houses, but buying and flipping these assignments, they would probably consider that to be business income and it's taxed a lot higher than if you can get the capital gains treatment on it. So that answer is kind of like the profit The profit side, obviously, if you sell it at cost, no issues. There's no gain, there's no loss. And then if you sell it below, like if you have to take a discount from what you paid for it, again, this kind of goes into the reverse. So now you kind of want it to be business income so you can write it off against your other income. So again, it all depends on the intent of the transaction that's going on here. But if you ever have this situation, like honestly, just reach out to your accountant or and they can kind of provide you with some guidance. But again, look deep in your heart and just say, okay, what was the intent of this transaction? Did I do this on purpose, or was just kind of like windfall into this situation? And I have to take a discount to get out of this situation that I'm in. So
I love Brennan's look deep into your heart. Look deep into your heart.
Yeah. Not that Siri cares, but
yeah. So Sachin, does that help you? Does that answer your question?
Absolutely. Yeah. Thank you so much.
Okay, great.
And then the last question I think he had was, it says here, like, what are the tax implications if we were to do the following with our pre-construction property, close and make it a rental and sell after 1 year? So you may or may not know this, but they just changed the way the rules are around this sort of thing. So now, no matter what, you have to own the home for at least 12 months before you can flip it. Whether you live in it or rent it, or else it's 100% business income. There is no capital gains treatment for you and or principal residence. So if you're buying your principal home and selling it 6 months later because the market's gone up by 100 grand on your house, they're now going to consider that business income and no longer be part of like sheltered tax-free money on your principal residence. So do watch for that, please.
But he can make it, he can close it and make it a rental immediately for a year. He doesn't have to live in it as his primary, because I know they were talking about that at one point too.
Yeah, that is true. However, if you rent it out for a year and then sell it, you're now just going to have capital gains when you sell it. Like you couldn't shelter it under the principal residence, A, because you weren't living there, and B, because it wasn't long enough. So,
got it. Okay. And then part 2 to that. Oh,
so I think that was his question, right?
Yeah. What are the tax implications if we do one of the following? 1, close and make it a rental, then sell after a year, or close, move in as a principal for 1 year and then sell after 1 year. I think if I understand you, the difference would be he would have capital gains if he used it as a rental for the first year, and he would not if he was living in it as his primary.
Right. As long as he lived in there for 1 year or
1
longer.
year.
Yeah.
Okay. Awesome. Thank you so much.
Yeah, no problem.
Welcome. And look deep into your heart.
Yeah. that was the hardest question on the list, by the way.
I'll tell you a quick one, just a quick example, because when I'm flipping houses, I have to pay all of that as income, right? Because it's a business. But when you purchase a house and you hold it, right, and then you go to sell it, it's as an asset, you're like years later, you're looking at capital gains.
Right.
Is that a good way to explain
The
it?
intent is like the long-term, it's more of a long-term goal versus like quick, get rich, flip it over, continue to do it again. So they're trying to avoid that for people. So.
Okay, good. All right. So this next question, if you're here, you can either raise your hand to show us who you are, or just ask a question in the chat and I can read it out for you to the host. So if someone is separated, they have 2 properties. One was transferred to me and the other one to my spouse. The home that was transferred to me has always been the primary residence. How do I show this transfer on my taxes? So let's start with that one. Let's stop there. Okay.
So in that scenario, nothing has to be done for you. So if you just get divorced and you do the equalization of assets at the time of separation, if you're the one keeping the house that you've always lived in, nothing has to be done until you actually sell the property. So.
Okay, wait, we've got go ahead. Yep.
It's Leah. Sorry, that's my question. So what dollar amount do I put on my tax return for that? Because it asks if you sold your primary residence. But do I put the actual deemed value of it, or do I put the difference between what it was purchased for and what that deemed value is, or
So-
what do I do?
No, nothing. You have to do
Okay.
anything because on the day that it always, like, you're just keeping in the house that you're living in now, right?
Correct.
So
Yes.
until that time happens that you do eventually move out, that's when you would report that transaction you're alluding to. But in terms
Okay.
of the date of separation in that tax year, so if it's 2022 or 2023,
Yeah.
I'm not sure which one is going to happen
It was
in.
22. Yeah.
So you,
So
you
I don't have,
no,
I
like
don't have to put, so I don't even have to declare that I sold that, even though it's a deemed disposition, because it went from joint ownership to mine.
it's
Nothing?
actually your ex-husband actually should be the one doing it, not you. So he should do that transaction on his return. Because now he's basically claiming that he had a principal residence up until the date of separation, and he's deemed to dispose of half of his interest at that time. There's no tax, but he should,
Right.
he should
Okay.
report. So whatever the value the lawyer came up with for your house, just
Yeah.
take half of it and tell him to report from whatever period you owned it till
Okay.
2022.
Okay. I don't really care what he does on his
I
taxes.
didn't think
I'm
you
more
would.
worried about mine. But the second question,
High
I'm
five,
really,
yeah.
that's my real concern, because I want to know what to do there, because, well, you can read the question.
Yeah. So the second one is the second property is a farm that was transferred to your spouse. And in the separation agreement, he's agreed to pay any capital gains. So I think she wants to protect herself here, right?
Yeah. So this
Right.
is
So yeah.
this is a interesting one, in the fact that, so a lot of times what happens is that you should really have to pay some of that tax. Now, it's good that your lawyer maybe didn't catch that. I'm not sure, but now it's falling on him. So so like any appreciation from 2000, like the date of separation till whenever that's sold, is all on him. Like a lot of times what happens is at the date of separation, they kind of calculate whatever the value of that property is worth, and they do like an estimated tax at that time. And then you
Right.
obligated to basically pay him that, or like your half of that tax.
Right.
But
So it's,
I'm not a lawyer, but I'm
Can-
just saying, like, I don't know
No.
all the full details. If that happens,
okay, can I clarify a little bit? He's not a stupid person, and he's done that because
Okay.
he is actually a farmer and farms the property. So I'm assuming that would fall in that farm
Property.
capital, lifetime capital gains, which I don't know what that dollar amount is. At 500,000 or a million? I think it's 500,000. I don't know.
Mhm.
So that's probably why he's
He-
gone that route, to say, well, I'm going to save you 40 grand because
right.
you don't have to pay this. I'll just take this on.
Mhm.
So my real question is, so that is a deemed disposition because it's gone from joint ownership from our names. Now it's just in his name. So when I'm doing my income tax, do I show anything there because it was a joint property, or again, he's taken that obligation? It's up to him and his accountant to look after that, or what do I do?
So in that scenario, so a lot of times what happens is on the day before the separation agreement, they do the transferring of assets as when you're still together, and then there is no taxable transactions at all. So you got your principal residence, he got the farm. When you were still married, you guys put them in each other's names, and then the date of separation happens and you just go your separate ways. So there's nothing you have to report at all in any of this scenario. Nothing.
Oh, okay. So, but our date of separation was like 3 years ago, and then this happened in 2022. We just did it in 2022.
Like, was the divorce, like the final divorce
We're
settled?
not divorced yet. We're just separated. So we have a legal separation, and that was part of that legal separation.
So you may want to go back to the lawyer and get them to do it backdated if they can do it. Because when you're still together, you can transfer assets freely between one spouse to the other. And so that's a lot of the times how they do the equalization of assets is pre-separation date. So that way it doesn't trigger any taxable events. Because if you do it afterwards, then yeah, there is a taxable transaction that happens, right? Like you're selling your half interest to him, essentially,
Right.
which
Right.
creates tax. If you do it when you're still together, nothing happens. There's no tax reported at all.
Okay,
So
so I'm
you-
still confused then, because if it's happened after the fact, because we were separated, I think it was January 1st, 2019. We did the separation agreement
Mhm.
last year, finalized it, and transferred the properties in September of 2022.
Right.
But in the agreement, it says any capital gains on that particular farm property is his responsibility.
So what normally happens is, so when you're together, the house that you're in today is going to be the couple's principal residence. You only have one principal residence between two people at any
Yep.
given time.
Yep.
So on the date of separation, like during that whole period of time, you had the farm, right? The farm.
Yep.
property. So
Yep.
think of it as like a cottage, same idea. So you have this
Yep.
extra property. So you can only elect your principal residence on one space.
Yep.
But once you've separated, well, now you have to pay tax somewhere on that second property. So that's why I was saying, if he didn't do it properly in the legal paperwork, then you saved yourself that, like, it's called like the crystallization or the equalization of assets piece. And so that's where you want to go back to the lawyer and just make sure that this was done pre-separation date. So he'll take it. So the capital gains will just always be paid whenever he sells the property. So let's say you owned it for 20 years. There's exposure of capital gains for 20 years. So then after that, moving forward from 2022 onward, all those years are now going to be his principal residence. But when he goes to sell it, let's say he keeps it for another 20 years. So 40 years in total, he's owned it. He's going to have to pay 20 out of 40. So like half of the gain will be taxable to him. Not 100% will be sheltered anymore. This is probably like blowing your mind, but this is a lot. This is not really like this is more of like, you have to go back to your lawyer and talk to them about this. Because it is it's not so much for you, it's a big deal for him.
Right.
Oh, she
Well,
doesn't
and
care
it's
about him.
yeah, I don't care about him. The lawyer's the one that told me that it would be a deemed disposition at the time that we transferred the property.
So
when I'm doing my income tax, so okay, I won't worry about the primary residence because I still own it, so that's fine.
Right.
It's just that other property, if I don't declare anything that it was even a deemed disposition, like I don't want to not declare something, but if I don't have to declare it, I won't either, because it's his responsibility to
technically
declare it.
if you do that, you're gonna be paying tax. I don't know what the gain is on the property, but let's say it's $100,000, like you're gonna be paying.
Oh, it's a lot more than that.
Right. So
yeah.
like now you're gonna have to come up with a huge sum of money to pay that tax for something you don't even own anymore.
Right.
So unless they factor that into the equalization payment, but I don't, like, this is what I'm saying. Like, this is more so you have to go back to your lawyer and just figure out kind of this whole situation. Because
what would be the question, if I can interrupt? So because you have to explain things to me a few times.
Yes.
What would be the question? Because I'm going to pretend I'm Leah. Okay. Because from my perspective, listening to Leah, it's like the fact that he has to pay that capital gains became part of our agreement. So that's the agreement. It's written in the lawyer's hand. So regardless if CRA or someone comes back to me. So, but where am I at risk?
So it just comes down to when that actually was dated. If it was dated after your separation agreement, you could be exposed. I'm not saying they may come back.
Okay. Sorry, after the separation agreement or the date of separation?
Date of separation, because you're no longer together. So if the deal was signed 2 years later, well, now you're not separated anymore. Now, you're selling your half interest of that property, and it is taxable to you.
Even though the agreement says that he's covering
it goes, but I'm telling you two sides. What CRA could challenge is that, well, wait a second, you signed this thing 2 years later. You guys weren't even together anymore. It's a taxable event to you. You would have to pay tax on it, 50% of your interest of that property. I get the intent behind what was done, but I'm just saying, from an exposure point, you may have some exposure to yourself if something ever came back and they looked into it, if it so happened to be signed after your date of separation. This is what I was saying. Most people do this kind of at the time of separation to avoid all these headaches, because you can transfer assets from one spouse to the other and while you're married, and there's no issues. Like, there's no tax implications anywhere.
So should I even put anything on my tax return for that and let him do it and see what happens? And play stupid because I do my own and go, I was told I didn't have to, because
that doesn't ever hold up in the court of law. But I would say, like, for this situation, again, it boils down to the intent. The intent was never to, like, skirt around you paying the tax. The intent was like
No.
in the separation agreement, he was agreeing to pay tax, and if
Right.
he does, fine. If he doesn't, that's not your problem either. So
Right.
just
Okay.
note that you signed something, but there could possibly be some tax exposure depending on the dates. Again, like I said, I don't have it in front of me. I can't tell you. I'm just
Yeah.
going by what you're telling me and the situation that you presented itself.
I'm not an accountant and I'm not a lawyer, but Leah, if I was in your position, I got the lawyer's document right here. that
Right.
says
Yeah.
that he's paying
And
tax.
I've got my separation agreement that says,
Yeah.
that it specifically says that he would pay the capital gains on that property.
Okay. Yeah.
But I
so-
appreciate,
So-
Brennan, what you're saying, because you're adamant
Yeah.
about it, because you're like, he's like this one, because I always tell him, no, listen, because I try and use common sense. Common sense doesn't exist in the
Yeah.
government.
The government
So-
doesn't
Yeah.
either.
Yeah. So I do appreciate you letting Leah know, like adamantly, even when we're trying to change your mind, that she may
Yes.
essentially have exposure. Like
Yeah.
that
Yeah.
is good.
Yes. Thank you.
Yeah. By doing nothing isn't going to trigger them to look into you, right? The only way they could ever find it is somewhere down the line if he never reported it, and somehow, because they have access to the Land Registry Act.
Right.
So if he never reported the sale, I don't know, like
Mhm.
maybe it could be years from now, it could be 10, 15 years from now, like who knows? Right.
Yeah.
So,
Okay.
but yeah.
Laminate that agreement from the lawyer.
Oh, I trust me, it's in safekeeping.
Okay.
Okay. Thank you.
Yeah, no problem.
Thanks, Leah. Okay, that was great. That was really good, Brennan. And you don't break down easy, because that is kind of how I work you too. Like, no,
Yeah.
but you don't understand. Okay, what is this one now? What's the most overlooked tax credit by the average taxpayer? And this was my question. So you can maybe say the biggest changes that have happened that we may not be aware of, or anything you'd like to say.
Do I have that somewhere else? Hold on 1 second here. Yeah, so this is kind of like a two-parter. I don't know, I wouldn't say there's like one specific tax credit that is overlooked the most. The big one, if any of you guys have young kids, is that obviously everybody knows like daycare counts as childcare expenses. But what people kind of forget about is if, in the summertime or March break, you put your kids in like, day camps while you're working. Those are also considered, childcare expenses. You can deduct them because they're like sports and all that kind of stuff is gone by the wayside, which some of you may or may not know, like for many, many years now. So this is one extra way to like put them in a sports camp and you get to deduct it for tax purposes. The other big one that most of you may know about this year is the staycation tax credit. So if you vacationed anywhere in Ontario, whether it's Airbnb, hotel, camping, lodging, all that kind of stuff, up to $2,000 per family is eligible for the credit, and it works out. If you hit the max at 2,000, it's like $400 back in your pocket, which is kind of nice. So you get 20% off your stay essentially if you vacation here in Ontario or vacationed in Ontario in 2022.
I get that credit, Brennan.
Yeah, so keep your receipts, give them to your accountant, and they'll put it in for you. So those are the two, like most people probably did some sort of, even if it's like a night in Niagara, a night in Toronto, hotel, it all counts. Doesn't have to be far, just something, put it in, you'll get something back for it.
That is interesting. Okay, I'm gonna, is anyone, put your hand up if you're self-employed in here, just your digital hand, because I'm gonna add a question, but I'll avoid it if no one else is self-employed, except for my team. I know you guys are, so I guess it will help you, so never mind. Next question from the group was the underused federal tax rule and how to complete the application form.
Yeah, so
If you're here and that's your question, raise your hand, let me know.
this really only applies if you kind of have a rental property within a corporation or you have a partnership, or if it's in a trust. Sometimes people actually fall or are going to fall into this if you die and you have a property. Technically, when you pass away, the estate kind of forms a trust. So if you have a residential property within an estate before it's been sold, you may kind of get caught under this rule, unfortunately. So do watch that if any of your friends or family or somebody has a death in the family, just kind of make sure that they're aware of this. The penalty is actually really steep if you forget to do it. For basically individuals, I think it's $5,000 the penalty, and for corporations it's 10,000. So
this is can you just tell me the situation again that this would be triggered?
So it really only applies to people who have like corporations with residential properties in them, or trusts, or if it's like a partnership, like let's say you and I were landlords together, we would be considered a partnership because we're not related. And we would have to file this declaration form, basically just saying, yeah, okay, here's the property. There's no tax associated with it. It's just kind of like an information form for you. They just don't want people parking foreign money into these properties and just kind of holding them. So they want to make sure you're using them. And if you aren't, then there's a tax. I think it's like 1% of the value of the impact value. So yeah, they're trying to, well, they're trying to get out the people from just, having all these, there is a shortage of housing in this area and all of GTA. So they want people to actually live in these houses, not just use them to park as investments.
I'm not sure who wrote this question, but my question is, they use the term underused. What is that?
So, yeah, that's what they call it, I guess, but that's the declaration form.
Okay, got you.
I just actually have a question because I know Sean could challenge this. So is it going to be completed by the lawyer or the accountant?
Usually the accountant, unfortunately. Yeah, because this is like an annual thing. This isn't just like a one-time thing. So this would be something you'd file with your taxes every year, and it is due April 30th. So do be careful. And this year is the first year that it will be due for everyone that this would apply to. So yeah, make sure you file by April 30th of this year, and every year moving forward, I guess.
Okay, I'm going to throw in another question in between the next four, and that is something I heard recently about living trust. We're actually going through this right now. So for instance, Mike's parents own a property, right?
Mm-hmm.
And I remember we had gone to the lawyer to say, hey, maybe now would be a good time to put the property in Mike's name as well, or whatever. And he said, no, you don't want to do that, and said nothing else. But then recently this week, I heard about this living trust that they say is better than putting don't put properties in your name directly, have it in a living trust. Do you know anything about that?
Like, is it their principal residence, or
assuming it's their, well, I'm going to ask you either or, whatever's easier for you to answer. I'm just saying this living trust versus putting your name directly on your parents' property.
Like sometimes what people do is they put their names, like if it's just in your case, if Mike's the only sibling that's going to be inheriting a lot of this stuff, then before you die, a lot of people just do it for probate purposes essentially, but you can bring on someone on title to that property, and you can do it in there's a way to do it like for like the trust part, but for simplicity, you basically just do some forms with the lawyer, bring on the beneficiaries. They're not really on title, they're just there. And then when the person eventually does die, or the mom and dad do pass away, Mike in this case is already on there, and he just goes back to the lawyer. They take the names off, and it kind of skirts probate that way. So that's kind of the big reason to do something like that. So perhaps that's the angle that they're trying to get at. But yeah, I've never really heard of a living trust. Usually when I hear trust, I think of like money, assets, designated for family members or something like that.
Yeah, it could have been in the States too. I'm not sure. So that's okay.
Oh, maybe that was it. Yeah. I don't know any US tax. So
all right. Okay. The question is from Christy. Okay. Okay, I'll read those in a second. Sandy, I see your question. So how does capital gains work? People are always afraid of capital gains. And before I even finish reading the question, guys, if you're paying capital gains, it means you made some money. Okay, so let's remember that. How does capital gains work in Ontario when it comes to renovations, upgrades to the home, etc.? If you have $200,000 equity in your home and I painted the interior $1,000, put in a new kitchen for $10,000, added a garage for 100,000, is the full amount of renovations and maintenance taken off of the 200,000 value equity?
So certain things would go towards we call it like the cost of the property essentially. So whenever you buy a property, let's say it's 500,000, that's your starting point. And then things you would do to the interior or exterior of the home would increase that cost base. So, but it really only counts for like major items, like the interior painting usually is a no. Like doing some flooring probably isn't either, but anything like, major, you're putting a kitchen in, you're doing a bathroom, all that kind of stuff, decks, all that stuff adds value and would be like form part of the cost of your property. So instead of being 500, you spend an extra 100,000 into it. Well, now your cost base is 600,000. But usually, as Mel will probably, can attest to, if you put 100 in, you're probably going to get back more than 100. Usually, for the most part, you're going to generate more than 100 coming back to you. So in a way, yes, it's adding to it, but you're also getting more money. So it's kind of a wash in most cases, I would think, right? For the most part.
And you know what you were saying about what were you just saying? Oh, not the floors, but the kitchen. Well, like some people's floors cost like tens of thousands of dollars, depending on what they do.
Yeah, like I meant like if you were doing like a small little reno, like some flooring, but
is there a way to gauge? Like I know the CRA loves to put a lot of gray areas around. So is this one a gray area? Is it based on X amount of dollars, or is it just, again, you got to look deep in your heart, CRA?
They do have criteria as to like what they would consider like kind of general maintenance and stuff. Like if you're, you can't put in like, your flower beds every year that you have to replace, or, light bulbs and all that, stuff that breaks and will break continuously. These are things that are going to like be fixated and, improve the value of your home, right? So maybe you could argue flooring, maybe you could argue painting if you did the whole house, but generally for the most part, those would be just regular maintenance expenses to your property. But yeah, like anything major, like kitchen, basements, all that kind of stuff, finishing all that drywall, anything drywall, totally deductible for you, or not deductible, but like add to the cost base of your house. The problem that most people have is that they don't actually ever keep their receipts for a lot of this stuff if you've owned them. Mostly for cottages actually is the big one. The families, or maybe they've owned for many, many years, and they're like, oh yeah, I didn't know we could, do all that. And then at that point, I'm not going to say this on air, but yeah, we make something happen at the end. For you. So ask your accountant, he'll tell you, or she'll tell you.
Okay, good. So here's another one, and we've got a kind of two-parter. I've got it on the chat. So seniors looking for assistance with their taxes.
Yes.
Are there any programs for them to do it? And there's a two-part question to that in a minute.
Yeah, so this is one of the ones I wasn't really sure where they were going with this, but the only thing I know is that like here in Newmarket, we stopped doing it because of COVID, but we used to volunteer down the street at the local library here, and we would do like tax returns they were kind of like low income, usually like disabled people, or people that couldn't really afford to go get their taxes done from a professional. So we would just volunteer our time and do it. It took like 2 minutes a return. It was so simple. But there is an income threshold, I think, at the library, like 25 grand or less. So if you're under that, you can apply and you can go get it done by a CPA locally. I'm assuming they have them in areas other than Newmarket. Like they would probably have them at Georgina, Keswick, or Innisfil, like wherever you guys are located. Like reach out to your local libraries, and usually that's where they would offer them.
Do they also have I remember, maybe I'm remembering correctly, but I remember them actually back in the day, you could just send your stuff right to the government. Like don't fill anything out, just send their stuff and then they would do it. Like,
yeah, there is like I've never used it, so I can't really speak from experience, but I think there is something like a dial. You can like file your taxes by phoning in some hotline or something. Again, if you have like CPP and OAS or maybe one other slip, like I think you can do it that way. But again, I've never seen it or actually done it. So I don't know. Sorry.
I honestly believe that the government should be offering people in this low income some way that
Yeah.
they can, I mean, it would encourage them to file. And this is going to roll into this next question. To me, it's ridiculous. You're making like next to $0. Now, can you please pay us or someone to tell us
Right.
that? Like,
They were trying to implement a system where like if you made under a certain amount, they would just automatically file your return for you. But what was happening was they have all these, like it's great from like, so there's two governments. Obviously we have the federal and then we have like all our interprovincial governments. But all the provincial ones have like all these different tax credits, right? So if you live in Ontario or you live in BC, like there's all these different things. And so they realized quickly that like we can't just auto file these returns based on their income, because they could actually get things from the provincial side that they would actually have to see an accountant or like do something. Like for example, this staycation credit, they wouldn't get it if they like the government automatically filed their returns, right? So
true enough. So this comes to part two. Now, I have seen this before, especially with senior citizens. And, you know, if they don't have the support of people around them and they don't end up doing like multiple years of taxes. But a question just popped in my head. How the heck are they getting their CPP and everything and their OAS if they're not doing taxes? But that's my own question. The question here is, once someone goes to help an elderly neighbor, right? And they want to help them get caught up, bless their souls. Does it matter what order they do it? Can they start at 2022 and work back to 1901, or like, how does it work?
No, 1901. Yeah, no, you kind of want to do them in order. So usually what happens is this actually is more common than you might think. Like we see it quite often. People will come in, hey, we need 5, we need 7, we need 10 years worth of stuff done. It's surprisingly how fast it snowballs for people. And so we just kind of log in, we get authorization on their behalf, we see where they last filed, and we kind of start from there. The furthest back you can actually go is 10 years. So even if you haven't filed in 20 years, doesn't matter. They won't even accept them regardless. So the furthest back you can go is 10 years from whatever tax year you're in now. So in this case, it would be 2013 was the farthest we go back.
The government is smart because they've made it so difficult to navigate. I mean, you know, I'm not a numbers person. So if y'all are number people out there, then this is your gig, but definitely is not mine. But they make it so complicated for people who aren't in tune with this that you end up losing opportunities, you lose tax credits.
Yeah. Well, they say it every year. There's like hundreds and hundreds of millions of like unclaimed tax credits or money that's lost for not doing it. Like it's so complicated. Like even to do every single one correctly would be like winning the lottery like 100 times. Like it's impossible. Just so
it's very, very difficult. They're smart. Okay, another one. We're just about to the draw time, guys. I thank you for hanging in there, and I really thank you, Brennan, for going in the hot seat and being real. Like, you know what? I love that about you, because it's like, if you don't know, okay, well, this is the best way to go find out. And if you do know, you're a good opponent. I get way more animated than you do, and nothing I do will make you change your mind. You it's kind of annoying. Okay. All right. For small businesses just starting, what is the minimum income required before you must submit or claim taxes? And also, what's the minimum income required before you can claim tax deductions on your business? Interesting question.
Yeah, this one I had a little laugh at, I guess, but the right answer is actually like $1 would be the right answer for that. Same with income or deductions. The one thing that they do state is that they just don't want you to have like hobby stuff. So if there's no intent to ever earn any money in here, then just watch out for that. So if
I don't know what you mean.
So let's say you're like, you know, trading cards or something like sports cards or whatever. You're just kind of doing it for fun, or you're collecting coins and whatever. You're buying all this stuff and writing it off, right? You never have any intent to sell anything, or you're not really making any money on it, but you're writing off your travel and your house and all this sort of thing. Yeah, they're probably not going to like that. There is no like threshold. Like you can show a loss. Like if there is even if it's a not successful business, but you know, if there's income generated, and there is some legitimate expenses behind it, then yes, the losses are warranted and you can claim them. So again, like I said, there's a black and a white and a gray, and unless CRA comes knocking on your door, then you just have to be prepared to kind of like fight your position as to like why you have these losses or why you're deducting all these expenses every year and never making any money. So
you just brought up two questions on that. So one is, can you carry over? Let's say I have like, this isn't anyway, don't even bring it up. But let's say that there's losses that you have, right? But you don't want to use them right now. You have no income maybe necessarily in that particular business. Can you carry it forward? Like I'm going to wait and use these when I need them?
yes, you can do that. But the reason why they don't want these like hobby style businesses to kind of be the way they are is, so let's say you were working full time and you're making like $100,000 a year. That loss can significantly reduce your taxes on the other $100,000 that you make from your actual like day job. And so they don't want to lower people's income for just like, having a side hobby. That's never been an intent to like make any money, and now you're paying way less tax for doing something like that. So they put a kibosh to that pretty quick. But if it's a legitimate business, like Mel was kind of talking about, yes, you can actually carry those losses forward and or use them to offset other income that you may have in that year.
Two other questions I just thought of again. For kids, I know this was always a question for me when my kids were young. So they get a job at like 14. When are they supposed to file taxes? Like,
that's a good question. It's debatable. Really, there's no urgency to file as long as they're only making like a few $1,000s. Like you bid the minimum floor now, I think, is like almost 15,000. So like as long as it's under that, they will never pay any tax. So yeah, the only thing that they're missing out on technically is like they're getting RSP room built up for that small amount of income that they would earn, but there's no real rush. They don't
15,
do it.
when should they start then? Let me tell you that. When should they start? When do you know? Yeah, now I got to start.
Usually most people start kind of like around 16, 17 area.
Just because of the RSP room, or?
Well, once you hit 18, you start getting the GST credit usually, and that's
that's the trigger.
Yeah.
18.
Yeah, usually 18 is like the bare minimum we start doing it. Even if the client or the taxpayer has no income, we still file it because they would get that credit. It's worth, I don't know, a couple $100. So it's worth filing. It takes 2 seconds to do, and now they're set up in the system and away. And usually they're going off to school the next year. They'll have tuition and all that kind of stuff. So it's good to set up early.
And one question I just thought of before we get to this last one, because the last one's a little bit off this topic, and that is, what is something, as just normal people like us trying to do the right thing, what is something we can avoid doing that would be a trigger for CRA to say, oh, this person's interesting? We don't want to be CRA's star. So what's some things we can do to avoid being CRA's star?
There is no, I wish I could tell you, or else I would have no audits here at the firm.
You don't say that word. Yeah. It's called the A word. Yeah. Mm-hmm.
They're really, it's just an algorithm. They just, if there's spikes or dips and valleys, then they sometimes check it. That's all I can really advice I can give you there. Sometimes you're thinking, wow, this thing is gonna 100% get checked, and they don't do it. And other people have such small amounts that they're trying to claim for certain things, and they're the ones who end up getting looked at. Yeah. So it really is just hit or miss. There's no, I can't tell you anything other than that.
Oh, great, thanks. We got another account. Come on, no, I'm joking, Brennan. I'm joking. So, by the way, the professional title, you guys have all changed it, or someone changed it for you, the government, because they had to pay to redo everything, is chartered professional accountant, right?
That's right, yeah. Mm-hmm.
So we used to say CA for some people and CPA for some, but now it is CPA. You are a CPA.
I am, yes.
You're also a partner in your firm.
That I am, yes.
And you're also very, very helpful. I want to thank you for that. Now our next one, I'm going to give the question that's on the paper, but Bella's going to kind of expound on it. And then we're going to stick around, give thanks. Well, we can give thanks. I do too, but give thanks to Brennan and then do our draw. So stick around, guys. We're almost there. But do you have any suggestions for international students or those in Canada on a work visa? But before you even answer that, perhaps you can listen to Bella's more intense question, because I think it'll get answered.
Yes. Okay.
Yeah, back to the point actually that Melissa said, if there is any point when it comes to filing the taxes for temporary residents, I appreciate if you point it out, and after that I may ask something like about that.
Yeah, so this is actually an area that, well, I have never seen, our firm really doesn't see a whole lot of. I'm not really sure where a lot of these temporary workers or migrant, people coming into the country go. Like I said, we've been around for a long time, 40 years, the firm. I've been here 10 years. I've never seen one. So I can't really comment on that specific situation, unfortunately.
Which
But
really,
Mhm.
can I just, sorry, Bella, I want to interrupt you because this is a really important thing to remember. And actually, Bella and I were talking about something else earlier. And the point is, you know what you know, and you don't know what you're not exposed to, so you haven't had to dig
Right.
in. So when you're talking to, all CPAs are not the same. Make sure when you're talking to a CPA that they're familiar with your situation, that they have experience in what you're doing, because there are others that do, and they can usually point you towards one that has more experience.
Yeah, they have we kind of stick to what we know. We do a lot of tax focus, heavy tax, more corporate stuff, as well as personal tax. But yeah, there's so much to know. You can't know everything. Like, you would need a brain like this big to kind of comprehend all the tax rules out there. But yeah, it's for, as multicultural as we are here in Canada and even in this area, like we've all asked the same question. I don't know where they go. Maybe they go to the city. Maybe usually what happens is there's these firms out there that kind of market to these types of people, and they just become like Mel said, kind of experts in that field. And then usually there's just like a constant flow of new, immigrants into Canada, and that's who they go see. And that's usually how it works. And we like, obviously most of us like of descent are from somewhere else, but they usually will come to us years later once they've kind of like established and are working and all that kind of stuff. But the initial returns, yeah, we never see them ever.
Immigrants, yeah.
Yeah.
Bella, oh, you're on mute.
Yeah, so that was the question. So because I got the answer for that.
Okay. All right, perfect. Okay, so we're just in the last 5 minutes here now, and you got through the whole paper. You got through all the questions in the paper
perfect.
and then some. So I'm so happy that you're here. Do you guys have any other questions for Brennan? Put your hand up if you do, because I just want to really, like, Brennan has devoted this time after work hours in a very busy tax season. And I appreciate that so much. And Leah's got her hand up, I see. So Leah, yeah.
So I meant to ask and I forgot. So my son actually sold his primary residence. So for him, what does he claim on his income tax for selling that? Does he just claim, like, I know he doesn't have to pay any capital gains or anything like that, but what dollar amount does he claim on whatever that line is? Is it the sale price, or is it the difference from what he bought it for and sold it for?
It's just the it's just the sale price, like whatever you list for. That's it. And
whatever the sale. Okay. All right.
There's one other.
Thank you.
Yeah, you just have to watch. There's like kind of how many years he owned it. That's it. There's two parts: the price and however many years he was living in that house.
Okay.
That's it.
Okay.
Does
Perfect. Thank you.
Does he do his own taxes?
Well, a little help from mom, and so and it's like I came to that question like I don't know the answer. I haven't done that yet, so it's like I'm not sure. So okay, so whatever. So he lived in it like for a little over a year and a bit maybe, but it was his residential property.
Yeah, that's fine.
That's fine. Okay, so it's whatever the sale price is.
Yep.
Okay, thank you.
No problem.
Brennan, we have some people just asking best way to contact you. I'm just typing it in the chat here. What's the best way to contact you? Give me your email, I guess.
Do you want me to just put it in the chat box
Yeah,
here?
can you put it in, can you put your email and your phone number? And maybe your website. You guys can copy and paste that and put it somewhere that you have it. Because you do take on new clients, right?
Yep.
I'll be sending out the recording to everybody that that's here and that registered and requested it. So I'll also include Brennan's contact information in that as well.
Perfect. So put
okay.
just put your maybe phone number or email in the chat, and then Deb, thanks Deb. Deb will make sure that that gets out to everybody else.
Yeah, there you go. Yeah, no, it's been yeah, like what we're finding now actually is there's been like a shift in the accounting world. Like all these elderly accountants have just all of a sudden retired this last year. I don't know what happened. It's like, oh, we're done. Too many new things, too many new things to learn. We probably get like 3 or 4 calls a day saying my accountant retired. I need someone, you know, they left them high and dry going into tax season. So
here's a question for you, just on that note, for anyone listening. Like Leah's out in Belleville. Let's assume someone far away wanted to. Are you able to do it virtually, or do they can you do Zoom like since COVID?
Yeah, we can, like, well, now with COVID, everything, like there is no real barrier. We tend not to do anything out of province, but anywhere within Ontario, yeah, absolutely. We have clients all over the place that, you know, they move. They really probably started here at one point, and then they moved on or moved out of the GTA area. A lot of people have moved north since COVID. So we have a lot of clients that moved to Barrie, Aurelia, Muskoka. So yeah, like everything is done electronically. Sorry?
Brighton? Didn't
Brighton, yeah.
Yeah. Mm-hmm.
So yeah, everything can be done by phone, Zoom, however you want it. You can email us the stuff. We have a portal you can upload your documents to that's safe and secure. We have many different ways you can get us the information. So yeah, you don't actually have to physically be in the York region area to be a client anymore.
That's good. That's good.
Most of the clients we don't even like. There's some clients I have yet to meet, and it's been 3-4 years. Everything's just been done on the phone because of COVID, and I don't know, just the way it started. It's kind of bizarre. You just see their name on a piece of paper, like that's about as much as I know about them.
Hey, don't tell FinTrack that.
Yeah.
Oh, that's good. Okay, well, I appreciate it. And then there are other clients who keep coming back. You see them so much and you're like, oh man.
Yeah. Well, for me, like that's actually the best part. Like, you know, there's only so many numbers you can crunch before they all kind of start to look the same. But for me, I like the people. Like doing this is fun for me. I like seeing the clients, so I prefer them to come in personally. Just, you know, you create that relationship, and you know, they tend to stick around longer as well. So I feel like the connection is important, or the relationship building is important.
That's good. And tell us one, and then we're going to get ready. I'm going to pass it over to Sandy and she's going to do the draw, I think. Tell us one fun fact about you, Brennan, that nobody would know.
One fun fact. I don't know. I'm a big sports guy.
You have a family?
Oh, well, yeah, I have a family. I got 2 kids. Actually, my daughter just broke her arm on Sunday, so that was fun.
Oh, that's
yeah, she's like 1.5 years old. So
I don't know. How did she break that, Brennan?
yeah, they asked us that at the hospital too.
Yeah.
Like, is it foul play? We're like, what are you talking about? But I guess they have to ask the question. No, she just like randomly, you know, tripped and fell and just landed the wrong way and had to have like surgery the same day. And but she's good now. She's good now. Yeah.
Okay, good. Well, thank you again, guys. Okay, Sandy, I'm going to, we'll definitely do more of these. Oh, I do want to tell everyone on here too. This is something that we do. We do it with Brennan. Sometimes we combine some of our industry partners and we'll have like our mortgage broker on with Brennan. We have lawyers that we do sort of these little info sessions for us. We're attempting to consistently give you value. Okay. It's not all about, yes, we're a real estate team, but we know that it's not all about buying and selling houses. You got to manage your life. And there's a lot of unknown things that affect your life and affect your happiness. And that's what we're here to do, to just kind of give you those answers. and it's fun.
Yeah.
All right, Sandy.
Who knew taxes could be fun?
Who knew taxes could be fun?
Yeah. Alrighty, let me try to share my screen here. And of course, on schedule, Zoom does not want me to do it, but let me try this.
Can I win?
Do I need to give you permission? Oh,
It
here.
just doesn't want to. Oh crap! I'm already spinning. Sorry.
Okay.
Let me stop that.
Oh, it's got host. It
Is
won't
that
let
what it
you share.
is?
It won't let you share. It's saying, oh, here you go. All participants. Now you can share.
Okay, let's try that again now. All right. Ready? Here we go.
Yes. Okay. Yep.
Oh, congratulations, Helene.
We have a winner.
Aline.
Hello. I'm so
that.
excited.
I know.
I
Helene
never
joined
win anything.
and she wins. There you
I
go.
never win anything. That's amazing.
Okay, that's good. So Brennan, can you,
Yes.
I'll be Vanna. I get to be Vanna, right?
Yes.
Can you tell Helene what she has won?
Yeah, I guess the prize is 1 hour. You can ask me any questions you want. But yeah, that's the prize.
I'm so pumped. Thank you.
Yeah, any questions you have, you can email me or call me, whatever you feel comfortable with. I'm open to either or.
Okay, amazing. Thank you.
Okay, congratulations. Thanks, Lean, for coming on, and
Thank you.
Leah for sharing, and everybody for sharing, and we really appreciate it. We're always here to answer any questions, but thanks for having this hour with us. Thanks, Brennan. You
Thank
rock,
you,
brother.
everyone. Thanks, Brennan. That was awesome.
Yeah, no problem. Thanks, guys.
Thank you.
Yeah, everyone.
Helene's crying because she won. I can see it. Deb, will you make sure that Helene gets all the info? Okay, great.
Yes, I will.
Thank
right.
you.
Cool.
Okay, there you go.
Talk to you
Thanks
guys
so
later.
much.
Bye-bye.
Okay, bye. Have a great night.
Oh.